Well, great. Thank you all again for being here tonight. It's great. We got a good mix of people from all over the country. It's a good audience. And I want to go ahead and introduce our speaker. Is a fellow that I know from the Atlanta area, Don Bravaldo. Has been in the M&A space for, 20 some odd years or more. I'm just going to review his bio.
When you're having fun.
That's right. And but Don, he founded Bravaldo Capital Advisors in 2006, and the BCA firm provides full service investment banking to middle market clients, which is a segment that's underserved by larger advisory firms in many instances. As managing partner of the firm, Don has led BCA through a number of transactions across a wide variety of industries. Before he founded his firm, which is a very reputable firm and one of the top M&A boutique firms here in Atlanta. But before founding that, he's led a middle market group at a Southeastern M&A advisory firm and oversaw all North American M&A activity for a Hanger Orthopedic Group, which is a large publicly traded consolidator of orthopedic and prosthetic service businesses. And in all these roles, Don's administered all phases of the M&A process, including identifying potential sell-side opportunities, packaging businesses for sale, performing business valuations, extending and negotiating offers, conducting due diligence investigations, and managing the formal closing process. Don started his career as an auditor with Arthur Anderson and another firm, prominent local firm, large local firm in Atlanta called Bennett Thrasher. And Don's a member of the Georgia Society of CPAs, the American Institute of CPAs. He graduated cum laude with a BS in accounting from Auburn University. Don, we're glad you're with us today. It's all yours.
Oh, Jeff, well, thank you. And really appreciate the opportunity to join you guys. It's fantastic that you're getting things established again in Birmingham and anything we can do to help with that. And it's wonderful to see people from around the country. A lot of deal professionals on this Zoom, as well as corporate finance executives that have been involved in M&A. And so, what I would say is, yes, we have the presentation. We're going to, hit some really good topics, but along the way, I want to make sure that we have a really lively discussion. If there's a question that pops up, or if we're talking about something and you want to delve a little bit deeper, by all means, probably just shout at me, or you can raise the hand on Zoom and Jeff will be kind enough to alert me that that's going on. So I'm Don Bravaldo, president of Bravaldo Capital Advisors, and I am happy to report, at least here in the Southeast, and it feels like, nationally, the M&A market, the private M&A market has recovered, right? So we came out of a, very difficult period of time, over the last 18 months, and the market is pretty much functioning normally. That said, there are differences in flavors from different areas in the country, and Zoom is certainly a bigger part of what we all do now. So there's maybe a little bit less travel, but I am happy to report that the way we do things in M&A is starting to go back to normal. So I just don't have anything left to say, right? I mean, there's nothing more to cover. I mean, the title is M&A Impacts and Deal Making During a Pandemic. Well, the pandemic's still going on and deals are still happening. So we're going to have plenty to talk about in that regard. So here's a little outline of what we're going to cover tonight. I'm going to spend a little bit of time mostly focused on what's going on here in 2021. I'll try and compare that a little bit to 2020, of course. So kind of, run the tape on the numbers, talk about at a high level what the M&A market is actually doing. And just, for an FYI for folks that were at billion-dollar, multi-billion-dollar a year corporations and international businesses, our firm focuses on lower middle market transactions. And for us, that's $250 million valuation sizes and below. So most of the data is focused that way, though I think a few of the opening comments are really going to refer to the overall broad U.S. M&A market, which will go all the way up to mega billion-dollar deals. We'll talk about some of the impacts to the process. I won't focus too much on that because, again, I'll contrast what we were doing before and talk about where we are today on some of that. There's still a lot of changes that are probably at least going to be with us for more than a few years in the way due diligence is focused now, et cetera. So we'll get to that. We'll talk about preparing a business for sale. That really comes more so from what our firm does, bread and butter every day. About 70% of what we do is either helping a business owner plan their exit strategy. Hopefully we've gotten to meet the company multi-years in advance of a sale, or it's dropped on our doorstep and said, hey, let's go execute now. We can do a great job with both of those things, but we certainly like the long runway and feel like the landing and the takeoff is going to be a lot smoother with that. So that said, I do want to, for the corporate professionals in the room that are buying businesses, talk about that. I've got a couple of sections where I'll try and emphasize on the buy side a little bit, but by all means, stop and raise a hand and ask a question. If we have time, we will talk a little bit more about how an M&A advisor adds value to the process and really give you an overview of what that looks like. And then to conclude, if I'm really just running out of time because you guys are bored stiff and don't have questions for me, we'll do a little bit of a case study. And then darn it, I'll make you listen to 3 pages of Bravaldo Capital stuff if we still have time. I don't think that'll happen. All right, so starting off with the market overview. Look, GDP and unemployment have stabilized. They're not where we want them to be. I mean, GDP's probably headed in good shape, but it was due to a lot of government spending. So with that, there's still a lot of economic headwinds out there. We're not at full employment, as the Fed likes to say. There's the new variant running around, and is no joke. Know plenty of people that have experienced that, and it's not any fun, including yours truly. But hopefully, we'll get this thing behind us. We'll figure out as Americans, how to deal with it. We'll get booster shots. We'll do whatever it takes. But it is time to start reopening the economy and thinking about commerce. So I think most people are moving in that direction and doing it cautiously and safely, according to the states that you operate in, guidelines, and all that other good stuff. So I see it opening up here in the Southeast. And as I said, well, I didn't say, but for example, in-person meetings are finally starting to happen. And over the last, certainly last couple of months, but in the last several weeks, the regular fall schedule seems to be coming back. And we'll get into what that means for deal making. Certainly a big concern still caused by all that government spending, one would say, is the rising costs that are out there, deemed transitory cost by the Fed. And in the old days, we just used to call that inflation. Real big supply chain interruptions. We do a fair amount of work in the industrial space, and we've got a lot of clients that are having difficulty feeding supply chains, getting parts on time. And then you contrast that with, we say that we're not in full employment, but companies can't find good employees, right? So in the tech sector here in Atlanta, it's really hard to go and get people. I mean, thankfully, some of that is really just come from some of the companies that have located here. And we're fortunate to have a lot of net new logos moving to the Atlanta area. Talking about M&A volume, 2021 is on track to really exceed 2020 levels, which, given the dips, is not hard, but we expect it to really be a record year, even when looking back at past good periods of time. Um, the We'll get to valuations in a minute, but the market volume as well as deal values themselves are going to be up. And you certainly got your mega deals that are driving those trends. The $1 billion deals. We'll see that in some of the graphs in a minute, but it's also lower middle market. And I'll spill the beans if anybody hasn't heard. Congress is busy looking at Biden's tax plan, and the House Ways and Means Committee has come out with their own proposal just last week, and there's going to be a tax increase, and it's going to affect a lot of lower middle market business owners that were on the fence about selling. COVID wore them out, and then faced with higher taxes has really driven a lot of deal volume. We can talk more about that later on in the presentation. Debt markets recovered. The banks have gone from extremely cautious posture, and still will be in some industries that are still struggling, whether it be travel and tourism, or feeding equipment and supplies into those different industries. For example, you're going to be very cautious with those things, but for the most part, every other industry out there is all go. As long as that company's performing well, you're not having any trouble getting debt. And quite honestly, if you're doing a deal, banks are quite frankly willing to pile on debt, which is going to be a contributing factor, obviously, to the valuation side of things. I can say that just in talking, going to a couple of functions recently, where a lot of bankers were present, just to give you a flavor. Some of the comments were, feels like 07 again. I mean, I certainly feel that way on the M&A side of the house, selling companies. I mean, just based on the volume of what we're trying to keep up with here. But on the debt side of things, a good example, one senior lender pulled me aside and was saying, man, it's just crazy right now. I mean, for example, we had a $50 million a year revenue company that we had pushed into special assets. They weren't performing well. We didn't like where they were. And usually what that means for those that are inexperienced with, what it means to be in special assets, it means you're going to have to find a new lender. And usually that new lender is going to be at a different cost of capital from a traditional bank and senior lender. Well, surprisingly, that special asset client was refinanced out by another prominent senior lender. And so to think that one, regional senior lender viewed that as a reserve account, right? They're putting reserves on their books to protect against a loan loss and trying to show them the door. And another bank takes on the opportunity and says, it's a great opportunity. Let's go. So it shouldn't be too hard to get out there and get bank financing if you've got a good deal that fits the profile for senior lending. And quite frankly, on the debt side, there's been a proliferation of non-bank lenders. So even if it's not 5x5 on a deal for a bank, there's probably a different class of lender at a different cost of capital to do a deal. We also perform corporate finance advisory services for clients. So there's certainly a lot of value that we add for clients to help them get the capital that they need. And then every industry out there seems to be doing quite well right now. Broadly speaking, technology remains a huge favorite. We all noticed that during the depths of the pandemic last year, right? It's hard to run a business remotely unless you've got a good IT system. And some companies found that out the hard way, but there's been a lot of industries that have benefited from that. There's going to be a lot of technology industries that continue to benefit, right? As people come back physically to the office, or as companies try and fulfill missing workers and can't find them, they're going to turn to technology and capital improvements in their businesses to reduce labor costs because they can't find labor. Some of the other industries out there, industrials is another hot sector right now. And to get specific, I hate it when, investment bankers or economists or whoever, just say, broadly speaking, technology and industrials are doing well. What does that mean? Well, for our firm, we continue to have some specialization in e-commerce. We've done a number of e-commerce transactions, had a really incredible outcome for one of our sellers, and which we may talk about if we get to the case study. We've got a deal underway in closing stages right now. So e-commerce continues to remain hot. Industrial maintenance businesses and facility services, surprisingly, really, really hot industry. Managed IT services to bring it back home to the pandemic and thinking about running businesses remotely. Having a good outsourced technology firm to do what you used to try and do in-house. When these days everything can go to the cloud and you can save money doing it. That's why managed IT services is really hot. Private equity's picked up on that, and it was and still is a very highly fragmented industry, but it's rapidly being consolidated. Just like Jeff mentioned in my background, consolidating orthotic and prosthetic practices. That's exactly where the managed IT services industry is right now, in a race to get a national solution coast to coast. So a lot of crazy valuations going on. That's usually what we look for. I'm sure some of the other deal professionals recognize what we're saying. When there's smoke, there's fire, and when there's high valuations, there's a lot of deals happening and good opportunities to get involved. IT staffing, again, closely related, hot. Software as a service has always been a great sector, but right now, again, with the CapEx spending and trying to improve businesses and efficiency and reduce labor cost, software as a service remains a favorite. Branded consumer products has been a good industry to work in. A lot of food related items as consumer behavior shifted and people actually started cooking at home, and et cetera, et cetera. That trend continues, especially if you're in good for you type categories. We've done a fair amount of CPG deals over the years, and it's a space that we don't shy away from at all. We actually love working in. We're underway on a CPG deal right now. Anything that's manufacturing related that's going to feed into end markets that are related to infrastructure. A good example of that is we're looking at a manufacturer. They make CapEx, capital equipment type items that are used to maintain and repair the railroad industry. And so, real good beneficiary of probably a lot of government largesse headed that way. And that's not just a cynical investment banker saying it. There's tons of private equity groups that are way smarter than this kid that are out there looking for deals in this space. So value-added distributors, always a favorite as well. So just a few of the industries on fire. Well, what's driving all of this? Well, money. It's cheap right now and it's flowing everywhere and it's coming out of everybody's ears. And so they're trying to chase yield. You can't get that investing in bonds and treasuries and money markets right now. And doggone it, pension funds and endowments and everybody else have big gaps to make up when inflation's way more than what they can get with safe assets. So that flavor of investing has drifted down into the higher yield. Seeking the higher yields is naturally ended up into the private equity camp, and more money's flown in there. $2.3 trillion of dry powder and money to invest in the private equity world. And corporate accounts have a record amount of cash as well, where companies didn't know what to expect and built up cash hoards on their balance sheet of close to $7 trillion. Valuations, as we had mentioned, are close to being at record levels again. They've certainly recovered, is the best way to say it. We've got some charts on that, but I'll just go ahead and say that lower middle market transactions involving strategic type acquirers as well as financial sponsors, kind of a whole average of the groups of buyer community out there. The EBITDA multiples were 11.4 times. So, really, really nice number, up from certainly years past. If we break it down and we look at some of the hardest buyers to pry money from, private equity, their valuations on a private equity deal, which is fundamentally different than just selling to a strategic and handing them the keys, was at 7.2 times, which is a really strong number. One thing I'll get to that in a second. We talked about tax changes. This slide's a little bit dated. Again, what seems to be coming out of the House Ways and Means Committee, went and hit it up right before the call. Good cap gains, they're proposing going from 20% to 25%. So just a 5% increase instead of what Biden wanted, really jumping it up almost double. Now there's still going to be this net investment tax that is another 3.8%. So really in total, you're talking about 29% cap gains. Well, yeah. So this slide's a little bit dated. Instead of 39%, 29%. So I guess we'll all be thankful that they didn't get the extra 10%, but not so fast. This is Congress. They hadn't passed anything. So they're going to argue about it for another couple of months. Stay tuned and we'll see what happens. But this is a huge driver of what we're seeing this year. We will set records in terms of the number of companies that we've met with, talked with, counseled with. I don't know that we're going to set records with the number of companies that we've worked with. It's going to be right in line with the boutique where we try and average between 7 or 8, but we've certainly had a more difficult time considering how we're investing our time. And quite frankly, I feel a little bit sorry for a lot of the owners that have waited really late. Another thing to keep in mind with the House Ways and Means Committee proposal on the tax side is, honestly, they're proposing to make it somewhat retroactive, meaning it is in effect as of September 13th when the legislation was passed. And my friends in the legal field tell me that there were a record number of deals closed on September 13th in escrow and trying to follow the rules that are outlined by this pending or discussed legislation that still has to go through a lot of grinder to actually get to a bill that gets signed by the president and both houses ratify. So we'll see. There's a lot of technicalities the attorney was going into that I'd rather not get into on this call to qualify for that. And we've already hit up the debt. So let's look at some charts. We were talking about the middle market activity being up. You can see in the top left-hand corner a nice recovery in terms of the low point back in the second quarter of 2020. And I can tell you that was an ugly quarter, man. It was completely shut down. You know, private equity groups were inwardly focused on their portfolios. Corporations were inwardly focused. A bank wouldn't give you a loan, no matter how good the deal was. The only loan that they were worried about was processing PPP loans. So it's not surprising that was a low point here on the chart. You can see, again, as I mentioned, you have to go back to, 11.4 times EBITDA is the highest valuation in 6 consecutive quarters here. So very, very strong valuations. Again, this is the chart that probably includes some larger transactions and some strategic deals. We'll get to the private equity one in a minute. Another cut at this, just total M&A market, not just the middle market, but total M&A market really says the same thing. Lower left-hand corner chart, and then global M&A is doing the same thing. So there's some charts. Here's some more charts. It wouldn't be a good investment banker if I didn't make everybody's eyes go cross trying to figure out these charts in a quick amount of time. But I just really want you to notice the trends. The chart in the lower top right, left-hand corner is looking at private equity deals. And you can see that that the valuations have trended upward over the past 4 years, and we're at an all-time high. Deal count, number of deal count is at an all-time high. That's the tax-driven effects of lower middle market business owners selling out. And then adjusted EBITDA is pretty much in line with where we started. EBITDA multiples are pretty much where we started back in 2019. So what am I trying to communicate to you guys on the right-hand side? Really just talking about the quality premium in terms of selling to particular types of buyers. Out there in the private equity world, there's true private equity groups, there's family office investors, which in the old days of M&A, we just used to call very wealthy families. But now pretty much any wealthy family goes out and hires some really slick private equity investment folks to direct invest into deals, plus, manage a stock and bond portfolio professionally. And so it's almost like selling to a private equity group with one caveat. They don't ever have to sell their investment because they're the family. They can decide, when to realize the investment through a sale, whereas a private equity group every 5 or 7 years better return that capital to their investors along with some handsome returns. So quite a big difference, but also a big difference in valuation. Taking a look at the lower right-hand corner, what we're trying to communicate there is, yes, valuations are at great levels, but it also depends specifically on the performer. And we have a great data service that's able to drill down and actually quantify scientifically the premium that exists for a well-run business, right? A business that, has above average performance and, has a management team that is going to stay in place, and a business that is quite honestly owned already by a private equity group, because that category really means A, they know how to negotiate and how to sell a business properly and how to prepare to do that. And B, hopefully the good ones have actually added some value, created systems, better governance, installed a great management team. So really, if you look down here at this table, what it's saying is really there's a premium that exists, at least 1x more on the table of EBITDA multiple valuation if you have a quality business that is growing by 10% or more, or has really healthy margins of 10% or greater, and again, have a management team, etc. All right, we're going to skip over the old tax slide because I think we've hit that in the intro parts, and we're going to talk about impacts to the process. Was there any questions on some of the other slides that I just covered in overall broad market, what's going on right now? All right. If I think back again to getting some deals done, which we certainly did last year, and thankful for that. We were well positioned in technology and e-commerce to make that happen. But it was a learning experience for both our firm and for our privately held business owners. What I mean by that is more than, say, 50% of the buyer community that we met with them virtually. So really preparing to do our work, preparing to do a management presentation for a buyer group, which is typically a day-long event where your management team and your investment bankers are helping to present the company to a particular buyer. This is after they've already, gotten in and reviewed a confidential information memorandum on the business. They've asked a bunch of questions. They've looked at a little, kind of a precursor to a diligence room. So they know who the business is. They got the flavor for it. They would have signed NDAs at the very beginning. But this is really their first introduction to the company and the management team. And most of that, at least for buyers out of the Northeast and off the West Coast, it was all virtual. The Midwest and the South, for what it's worth, still continue to visit businesses personally, in person, because the business owners were willing to do it, and our clients were willing to do it. So I can tell you that it put some groups at a disadvantage, right? People that were willing to come down and meet in person, the sellers got a better feel for those groups. They just did. The groups that didn't and tried to do everything physically, they had to overcome that through valuation. We did not sell a business ultimately to a group last year that did not physically meet with our clients. And so, really happy that it's going back to more normal now. But I do feel like there'll probably be some preliminary type meetings that we'll continue to do in Zoom, and certainly question and answer. And then obviously with us, developing business too, just meeting somebody for the first time, maybe it's going to be Zoom instead of just hopping in the car and driving 4 hours to see someone for the hope and the prayer that they're actually motivated to want to work with us. New areas of diligence have certainly arisen, right? There's been winners and losers that have come out of the pandemic, and there's been a big emphasis on quantifying companies that have done well. Is it sustainable? Companies that have not done well, but the argument is being made, hopefully by the investment banker, that the business is recovering. Well, buyers are going to dig into that due diligence, and there's been enough time, right? If you're an industrial business and part of your problem was the fact that your business was shut down or closed forcibly by the state that you're in, or you had COVID outbreaks, or you couldn't get parts due to the same thing happening to one of your suppliers, all of that's in the rear view. If you're a service provider, like industrial maintenance, for example, we've got a client that we're working with in that category right now. They couldn't get into plants as a vendor to do the service work that they needed to do. And so all of their business pushed right on them, and they had an awful year last year. Well, in selling the company, we need to, number one, see that the business is coming back and that we can see that trailing 12 months performance improving month after month after month, in order to get credit for a quote unquote COVID type adjustment. And that's taken longer than we expected, really. But the business is functioning very well now, and is actually setting month on month type records, even back pre-COVID. It's just a question of getting prepared and getting the business in the market. They're going to find a nice premium that exists because of the work that they're doing right now. So this is where I try to throw in a little bit of a buyer community type thoughts. I know that this is probably more applicable to last year up until this point in time. And what I mean by that is traditionally sourcing deals, especially when we talk about strategic acquirers. Well, that's about meeting with your competitors. It's about meeting with your customers. It's about meeting with your suppliers. And where does that normally take place? Jeff Kamen, where does that normally take place?
You're on mute.
Oh, yeah. Obviously, meetings.
In meetings, and in particular, usually in trade shows. Those haven't been going on, or the Zoom trade show that I attended is not the same thing as being able to step up to the bar and have that conversation with one of your competitors, or that kind of thing. And so that's where a lot of the deal flow has come from traditionally for corporates. It's been a lot more difficult. I think they've paid more attention to investment bankers knocking on their door with deals. They've been active, so it's been a lot of outbound contact, right? Reaching out. I usually get hit once a day from private equity looking to buy something. What do we have to sell them? I am getting more corporate inquiries directly from business development managers than I ever have before 23 years of doing this. So that's just a result of them not being able to go to the normal channels that they would have gone to otherwise. And again, here in the South, there are some trade shows that are starting to happen, but it's not back where it normally would be, and it probably won't be until next year. investigating acquisitions. I mean, again, that's the biggest change, and it's hard. I'll tell you, I don't know that I would buy a lower middle market business where I didn't go out there and look directly at that management team that I was going to depend on to run that business. Of course, if I was a strategic acquirer and I was going to fire them all and put my own people in, it's probably less of a concern. But it's the private equity groups that I know that have bought businesses without stepping foot physically in those businesses, or met and stood across the table from and shook hands with somebody that they're going to depend on to run the business going forward. But a lot of those deals happen. Heck, we had a former client who came to us to raise capital and to the tune of several hundred million. And we focus on M&A. We don't do early venture. And I told them, man, this is probably, given the sector you're in, it's probably a Goldman type deal. And I said that thinking, yeah, I don't know if Goldman really would do this. Goldman did that deal, and got them several $100 million from one of the largest venture funds out there. Neither Goldman, the venture fund, the attorney that worked for the target company, none of them ever met physically on that transaction. It's crazy, but that's what happened last year and some this year. And again, things are returning back to the old way of doing things. So call me old fashioned, but risk analysis, that has changed. And, again, I think that sustainability is really, really key for the businesses that are performing well. I think we have less of an argument out of folks. Example, kind of e-commerce. Well, is this just one and done while people aren't able to go out and go shopping? No. Now we can see with the second year of just massive growth in e-commerce that consumer behaviors change. So it's getting a little easier to defend, but it doesn't mean that buyers aren't going to dig in on certain points. Or, if the investment banker's very overly generous with, a COVID adjustment and is throwing all of the other trashy problems in there, like increased transportation costs and supply chain disruptions that are totally unrelated to COVID, but more related to, a reset of the whole Asian supply chain. Well, they're going to dig into that a lot more and not just let COVID be an excuse to ignore it. We
Hey,
talked
Don,
about.
I have a question about risk.
Sure.
In the M&A world, as we both know, there's different kinds of insurance. There's reps and warranties insurance and contingent liability insurance. Have you seen an uptick in those insurance products at the mid-market?
The easy answer is yes. You spent almost 25 years in insurance. So, if there's money to be made, those doggone insurance companies are going to figure out how to go make it. And, they've done very well at what I'd call middle market type style transactions. And starting about 8 years ago, I started to see reps and warranty insurance creep down into lower middle market. And what we're talking about with reps and warranties, if you sell a company as a seller, there's going to be a representation that you've paid your taxes, that you're incorporated correctly. And it could be a rep that, there's no environmental liabilities. It could be it depends on what's negotiated. And, there's a lot of time that's a real hassle fighting about that stuff. And so insurance companies have stepped in and said, look, we can provide an insurance policy that says if there's a breach of that rep, we can compensate you, Mr. Buyer. And, everybody pays a big fat fee, but we don't have to escrow 15% of the purchase price for 18 months to make sure that all of that stuff burns off. And sellers are generally happy with getting all of their money at the closing table than having, a 10 or 15% percent of the purchase price escrow hanging around. So,
Don,
Jeff, yeah.
Don, I've been on a couple of calls recently with insurance brokers, and they're saying that if you don't sign up for reps and warranty insurance this week, you're not going to be able to get it in 2021. I'm curious what you've heard.
I've heard the same thing, Bill. Look, right now at this point, there's a mass, we talk about, supply chain disruptions. There's a professional community disruption. There's a lot of deals trying to get done by the end of the year. The small departments at the major carriers that do reps and warranty only have enough bandwidth to do a certain amount. So yes, if you're not in process, having signed a letter of intent to, really I'll be overly, optimistic. By the end of this month, I don't see you getting a deal done, especially if you need to have reps and warranty. So what we may see is, depending upon how this tax thing continues to go, if it starts to ratchet back up, I mean, it's still, I'd like to put the 5% difference in my pocket, but we may just see a return to the way deals were done before reps and warranty, and just having escrows and not having the insurance, because I agree with you. It's going to be difficult for every deal that wants it to get it. And that goes for M&A attorneys. That goes for CPAs that are doing the due diligence. The CPAs doing quality of earnings is what they call due diligence these days. I've heard that they're I've heard that they're 8 weeks out on being able to look at anything new. So that's also bad news trying to get deals done.
Don, just heads up, we got about 5 more minutes hard stop. So I know we've got a lot to cover, but if you can kind of start to taper it down. Thanks.
Right. You got it. Here's something that's really important, because I think there's a few advisors out there. I just kind of jotted down that have clients who are thinking about selling. This is probably the most important thing I can communicate. It takes a village to sell a business successfully. That is, if the seller wants to maximize value, wants to do it professionally, and wants to ensure that the least amount of risk that they don't get their deal done from things going wrong. But M&A advisors, transactional attorneys, get specialists, and preferably specialists that have some ability to either get familiar with one another, i.e., let's start planning several years in advance, or they already know one another. I could go into a million things that are mistakes, but failing to plan is the most important one, and very closely followed by business owners that lose focus on the business during a transaction. And quite frankly, what's going on right now, a lot of business owners are just reacting to knocks on the door. And they think that just because it's a big publicly traded company that finds them desirable, that suddenly that equates to the highest valuation and that they're going to get a deal done. I just had a $20 million valuation company that we were introduced to late, really, really big brand name private equity group, had $20 million offer on the table, one buyer. He said, Don, I'm sorry I met you late. I could have run a sales process. This is for us. The private equity group just retraded on him 3 weeks out from a closing. And it was enough of a retrade that he's going to walk. And now we've got to start all over again. He's going to miss the tax deadline. So one buyer's no buyer. Keep that in mind. We're still in a good economic period. We think that while things may look a little crazy out there, ultimately there's enough money sloshing around in the system to keep things good well into next year. I think by fourth quarter next year, some of the inflationary pressures will cool off, and the economy may start to slow down a bit. I'm just going to kind of cruise through this and give you guys just an idea of what a professional sales process looks like. Our team does everything soup to nuts for a client, from, again, the planning to valuing the business, telling them a range to expect, putting together a professional marketing plan, preparing professional materials like an information memorandum on the business. And then we run an active marketing process where we've reached out and contact strategic buyers, private equity buyers, every one of which will have a strong transaction rationale for looking at this deal. And then we get a competitive auction going. And that's where the fun starts. Everybody likes to think that investment bankers spend all of their time wheeling and dealing. And quite frankly, we spend about 5 months actually getting something to the point where we get, a couple of weeks of negotiating ability. But that's what we live for. So with that, I want to make sure that I give an opportunity, 5 minutes here at least to answer any questions, dive into any more subjects. Bill asked a good question. Jeff did too. What about some of the others here on this Zoom? Crickets. All right. Well,
I don't have a question, but I just want to say this is great. So thank you, Jeff and Don, for putting it together.
Oh, thank you.
Hi, it's Erin. I was just curious what your experience is, or if you have a view on M&A in financial services space, investment management, wealth management, asset management. I mean, certainly some of the big news over the past week is the potential Invesco State Street merger. And certainly I have my own views. I'm just curious if you have a view on M&A in that space and what you expect to see or when you expect to see it.
Well,
Thanks, Don.
it's hard. Thank you. That's a great question. It's hard for me not to have an opinion because I see a lot of the community that our deals come from consolidating. There's a lot of boutique, kind of RIAs, large RIAs, kind of on the old wirehouse model as well. There hasn't been a great job of grooming that next generation of successors, and because of that,
No,
a lot of these smaller
they're left without a way to recoup the valuation, monetize what they've put into it for so many years.
right. So I'm bullish on the sector. We don't do a lot of work in it. There are a couple of specialty firms that do. But again, we're very closely aligned with it because probably about a third of our referrals come from the wealth management community. So we work very closely with them. Yeah.
Great,
I think
thank
it's
you.
great space.
Yeah, I mean, I kind of think in that RIA space, there's a huge opportunity. I don't know if it works for anybody on this call. It's certainly something I've thought about, but don't think it's right for me, about finding these RIAs that are close to aging out, making a deal with them to go in, shape up their financials, cut some fat, figure out how to tell the story, and working out a deal to sell them. And then
Well, if you
moving
end
on
up
and doing the
doing
next.
that, Aaron, definitely contact me and I'll try and put you in touch with some of the folks that we think might be good clients. I think there's a good market for that. It's,
Yeah,
as you know, it's getting through to them that it's sometimes hard.
yeah, I think they need someone that can come in and take them by the hand, do the work for them, show them what they can get out of a deal like that, and monetize their investment.
We're going to need to wind it down now. At the end of your presentation, which, by the way, we'll make sure all you guys that want it get a copy. You've got your contact information. Is that correct? Do you want to kind of maybe do a little bit of an overview there, where to find that? And yeah.
Well, Bravaldo Capital Advisors, and it's right there. But Jeff will get a PDF copy of the deck out. My email address would be D Bravaldo, first initial, last name, and should have done a better job of putting that in here. But in any event, I really, really appreciate the opportunity to meet everybody tonight, and hope this was valuable. And contact us if you want to keep talking. If you got a situation, we're more than happy to help.
Don, we thank you so much for coming. That was fantastic. And some of you have already emailed me at jeff.moore@jemore.com. I put that in the chat. If you want the slides, and we may well be sending out the video of this, and along with that would be the PDF of the slides later. But do feel free to reach out to Don. He is a highly reputable, gifted, talented professional here in the Atlanta area. So don't hesitate to reach out to him if you think he can help you. But again, Don, thank you so much for coming.
Thank you.
Appreciate
Appreciate those kind words. Thank you, Jeff.
Thank you, Don, and thank you, Jeff. This was a great session. Thank you.
Thank you.
Thank you.
Thank you, Bill.
Just a couple of
Thank you,
last
everyone.
Thank you, Don.